This presentation is devoted to Chapter 9, which introduces a Semi-Markov framework for life and health insurance. The general objective is to move beyond the classical finite state Markov model when actuarial transitions depend not only on calendar time or attained age, but also on the duration already spent in the current state. This issue is central in health insurance, disability insurance, long-term care, and more generally in any contract where the likelihood of recovery, deterioration, relapse, or death changes with the time elapsed since entry into a state. The chapter explains how to preserve the multi-state structure that actuaries are familiar with while enriching it by a duration variable. The key message is that the state process alone is not Markov in general, but the pair formed by the state and the elapsed sojourn time is Markov. This enlargement of the state variable is technically more demanding, because the new state space contains a continuous duration coordinate, but it provides the right basis for pricing, reserving, risk decomposition, statistical inference, and simulation. This overview section sets the structure of the presentation. We first identify why semi-Markov dynamics are useful in life and health insurance. We then introduce the modeling objects, starting from a Markov renewal process and moving to the semi-Markov kernel and the associated transition rates. The next part focuses on transition probabilities, sojourn probabilities, Chapman-Kolmogorov relations, and Kolmogorov-type equations. After this probabilistic core, the presentation turns to actuarial valuation, including cash flows, equivalence premiums, mathematical reserves, Thiele's equation, and the distinction between risk premiums and savings premiums. The final part explains how the model can be estimated and simulated in practice before concluding on its actuarial scope. The chapter develops a general framework for life and health insurance contracts, where transition rates can depend simultaneously on calendar time and on the time already spent in the current state. This is the defining feature of a semi-Markov model. The construction starts from a Markov renewal process, which records the successive states visited by the insured and the times at which transitions occur. From this discrete sequence, one obtains the continuous time state process and the elapsed duration process. The important conceptual step is to consider these two quantities together. Even if the state alone does not satisfy the Markov property, the enlarged process made of the current state and the elapsed duration does. This allows one to build a rigorous actuarial valuation theory. Transition probabilities, premium formulas, reserves, and Thiele equations can all be written in this enlarged framework. The chapter also shows that the model is not only theoretical. It leads to explicit likelihood estimators under piecewise constant transition rates and to a direct simulation algorithm. In that sense, the semi-Markov model is a natural extension of classical multi-state models for contracts where duration effects matter. The motivation section explains why a duration variable is needed in actuarial modeling. The guiding question is simple: is the current state sufficient to determine the future dynamics of an insured life? In many insurance applications, the answer is no. Two policyholders may both be disabled today or both be in long-term care today, but the future transition intensity may be very different if one entered the state 1 month ago and the other entered it 5 years ago. The semi-Markov framework is designed precisely to represent this kind of heterogeneity. It keeps the structure of a finite number of states, but it enriches the information attached to each occupied state by the elapsed time since entry. In life and health insurance, transition intensities often depend on the duration already spent in the current state. This is particularly clear for disability and sickness models. The probability of recovery is typically high shortly after the onset of disability and may decrease as the disability spell becomes longer. In long-term care insurance, the risk of death or transition to a more severe dependency level may also depend on the time already spent in care. Similar duration effects may appear in unemployment insurance, critical illness insurance, and recovery models. A standard finite state Markov model can represent dependence on age or calendar time, but it cannot distinguish between two insureds occupying the same state with different past durations. This is restrictive because actuarial cash flows often depend on the persistence of a state. A semi-Markov model solves this problem by preserving the finite set of states while adding the elapsed duration as a conditioning variable. The resulting model remains interpretable for actuaries because states still correspond to insurance statuses, but it is much richer dynamically. The key actuarial benefit is that premiums and reserves can respond to duration-dependent transition rates, which is essential for realistic valuation. We now turn to the probabilistic construction of the Semi-Markov process. The starting point is not the continuous time process itself, but a sequence of states and transition times. This is useful because a Semi-Markov trajectory is naturally described by the successive states occupied by the insured and by the lengths of the sojourns in those states. The section introduces three central objects: the Markov renewal process, the Semi-Markov kernel, and the transition rates derived from the kernel. Together, these objects describe where the process goes next and how long it remains in the current state before moving. The displayed definitions show how the continuous time Semi-Markov process is constructed from the underlying Markov renewal process. The counting variable gives the number of transitions that have occurred up to time t. The state process is then obtained by taking the state visited at the most recent transition time. The duration process measures the time elapsed since that most recent transition. The state space remains finite, with states representing insurance situations such as active, disabled, recovered, dependent, or dead. However, the trajectory is driven by two sequences: the visited states and the transition times. The sojourn time is simply the length of time between two consecutive transition times. The essential assumption is the Markov renewal property, stated as equation 9.1 in the chapter. It says that once the current state and the time of entry into that state are known, the distribution of the next state and of the next sojourn time is independent of the earlier history. This is weaker than the Markov property for the state process alone, because the time already spent in the current state is allowed to influence the future. It is precisely this feature that makes the model suitable for duration-dependent insurance risks. The Semi-Markov kernel is the object that summarizes the dynamics of the Markov renewal process. The displayed expression defines, for a transition from one state to another, the joint probability that the next state is a given destination and that the sojourn time in the current state does not exceed a given duration. Thus, the kernel contains two pieces of information at once: the destination of the next transition and the timing of that transition. Taking the limit as the duration tends to infinity gives the probability of the next state, conditional on the current state and on the time at which it was entered. Summing the kernel over all possible destination states gives the distribution of the sojourn time in the current state. The chapter also introduces the conditional distribution of the sojourn time given the next destination state, which separates the timing component from the destination choice. The embedded chain is the sequence of visited states. It behaves as a non-homogeneous Markov chain because its transition probabilities may depend on the time of entry into the current state. This is important actuarially, since the age of the insured or calendar time may influence where the process moves next. The slide translates the kernel into instantaneous transition rates. The first displayed relation says that the rate of moving from the current state to a destination state is obtained by dividing the local density of the kernel by the probability of still being in the current state at that duration. This is the standard survival analysis logic. A hazard rate is a local transition density conditional on survival up to that point. The second displayed relation corresponds to equation 9.2 in the chapter. It states that the survival probability in the current state is the exponential of minus the cumulative exit intensity. The cumulative exit intensity adds all destination-specific transition rates over the elapsed duration. This representation is crucial because it makes the link between the probabilistic kernel and the intensity-based notation used in actuarial multi-state models. Conversely, if the transition rates are known, the kernel can be reconstructed by combining the survival probability in the current state with the destination-specific intensity. The chapter also notes that a homogeneous Semi-Markov process would make the kernel depend only on the sojourn time. but this is often unrealistic in actuarial applications because attained age and calendar effects are typically relevant. The next part studies transition probabilities in the enlarged state space. Once the duration variable is introduced, transition probabilities are more complex than in a standard Markov chain. They must describe not only the state occupied at a future time, but also the elapsed duration in that future state. This has consequences for sojourn probabilities, transition densities, Chapman-Kolmogorov equations, and Kolmogorov-type differential equations. The main point is that the duration coordinate evolves deterministically when no transition occurs and resets to 0 when a transition occurs. The displayed definition introduces the enlarged process formed by the current state and the elapsed duration. This pair is Markov, even when the state alone is not. The instantaneous transition rate in this enlarged process gives the local rate of moving from the current state to a destination state at calendar time t, conditional on having already spent duration u in the current state. The second displayed relation links this rate to the kernel-based intensity introduced earlier. The entry time into the current state is the current calendar time minus the elapsed duration. This identity connects the two viewpoints of the chapter. The first viewpoint starts from the Markov renewal process and its kernel. The second viewpoint works directly with the continuous time process in the enlarged state space. A state is called Markovian when the transition rates out of that state do not depend on elapsed duration. If this is true for every state, then the whole Semi-Markov model collapses to the classical continuous time Markov model. Therefore, the Semi-Markov framework should be viewed as a strict extension of Markov multistate models, not as a completely separate theory. The transition probability displayed on the slide is the probability of being in a destination state at a future time with elapsed duration below a prescribed bound, conditional on the initial state and initial elapsed duration. 4 arguments are required: the initial calendar time, the terminal calendar time, the initial duration, and the terminal duration threshold. This is the first major difference with a classical Markov model, where transition probabilities are indexed only by the initial and final times and by the initial and final states. When the terminal duration threshold is infinite, the probability matrix is stochastic because all possible elapsed durations are included. When the threshold is finite, some mass is excluded and the matrix need not sum to 1. Locally, over a small time interval, the transition probability from one state to another is approximately the instantaneous transition rate multiplied by the length of the interval. This gives the same local interpretation as in a Markov model, but with an intensity that depends on elapsed duration. The duration coordinate must therefore be propagated throughout the valuation model, because it affects future transition probabilities and hence future cash flows. The exit rate from a state is obtained by adding the destination-specific transition rates over all possible destinations. This aggregate rate describes the local intensity of leaving the current state, whatever the destination. The displayed exponential expression gives the probability of no transition between 2 calendar times, conditional on the fact that the process has already spent a given duration in the current state at the initial time. Along a no-transition path, the elapsed duration increases deterministically as calendar time advances. This explains why the exit intensity is evaluated at a duration that grows over the interval. The chapter emphasizes that this no transition probability creates an atom in the distribution of the terminal elapsed duration. If the process stays in the same state, the terminal duration is exactly equal to the initial duration plus the length of the time interval. This atom is not a technical detail. It is needed in actuarial valuation because some benefits or premiums are paid precisely while the insured remains in a given state. For example, disability annuities or long-term care benefits may depend on the persistence of the current state. The displayed relation is equation 9.3 in the chapter, the Chapman-Kolmogorov equation adapted to the Semi-Markov setting. Its structure is more involved than in a Markov model because the elapsed duration at the intermediate time must be tracked. The first part of the formula describes trajectories that have already left the initial state before or at the intermediate time. For these paths, one integrates over the possible intermediate durations and sums over the possible intermediate states. The second part describes trajectories that remain in the initial state throughout the first subinterval. In that case, the elapsed duration at the intermediate time is not random. It is the initial duration plus the time already elapsed. This decomposition is fundamental. It separates paths with at least one transition before the intermediate time from paths with no transition before that time. The transition density appearing in the equation gives the distribution of the elapsed duration at the intermediate time. In matrix form, the same idea combines a density term with a diagonal no transition term. The actuarial implication is that future probabilities cannot be propagated only by multiplying matrices. One must also integrate over durations. The slide presents the forward and backward differential equations associated with transition densities in the Semi-Markov framework. The forward equation involves the terminal time and the terminal duration. It contains the usual loss term due to exits from the destination state, but it also contains a derivative with respect to terminal duration. This additional derivative reflects the deterministic aging of the duration coordinate while the process remains in the same state. The backward equation involves the initial time and the initial duration. It compares the density obtained when the process starts from the current state and duration with the density obtained after an immediate transition to another state, where the duration is reset to zero. This reset mechanism is the characteristic feature of the enlarged Markov process. These equations are the analytical signature of semi-Markov dynamics. They show why classical Markov differential equations are not sufficient when duration matters. In practice, these equations provide the basis for numerical computation of transition densities and probabilities, although the chapter also presents an iterative representation based on a fixed number of transitions under non-explosion conditions. The probabilistic construction now becomes an actuarial valuation framework. Once the transition rates and transition probabilities are defined, the next step is to attach cash flows to states and transitions. Premiums are generally paid while the policyholder is in a given state. Benefits may be paid continuously while a state is occupied, or as lump sums when a transition occurs. In a semi-Markov model, these cash flows may depend on elapsed duration. This is important in contracts where benefits change after a waiting period, after a deferment period, or after a certain duration of disability or dependency. The chapter specifies three families of deterministic cash flow functions. Premium functions describe payments due from the insured while the process occupies a given state. These functions can include continuous premium rates and jumps, which correspond to discrete payments. Lump sum benefits are paid at the moment of a transition from one state to another, and they may depend on the duration already spent in the departure state. This allows, for example, a benefit to vary according to the length of a sickness spell or disability period. Annuity-type benefits are paid while the insured remains in a state, again potentially depending on elapsed duration. The transition counting process records the number of jumps from each origin state to each destination state. Its intensity is the semi-Markov transition rate evaluated at the current elapsed duration and multiplied by the indicator that the insured is in the origin state. The cumulative benefit process, displayed on the slide, combines state contingent annuity payments and transition contingent lump sum benefits. Premiums are represented similarly, but only through payments attached to occupied states. This notation is general enough to cover many life and health insurance contracts. The slide presents the equivalence principle in the Semi-Markov framework. The expected present value of premiums is set equal to the expected present value of benefits over the contract term. The first displayed relation states this equality. The second displayed relation gives the premium side. Premium payments in each state are weighted by the probability of being in that state at the payment time, with the terminal duration integrated out. The benefit side, developed in the chapter, is more complex because benefits may arise either from being in a state with a given elapsed duration or from making a transition at a given time with a given previous duration. This is why benefit valuation requires both transition densities and no transition atoms. The atom corresponds to the event that the process has remained in the initial state since policy inception. Once the premium structure is fixed, for example level premiums or single premiums or state-dependent premiums, The equivalence equation determines the premium level. The actuarial logic is the same as in classical life insurance, but all probabilities and cash flow weights are now computed in the enlarged Semi-Markov state space. The mathematical reserve is defined as the conditional expected present value of future benefits minus future premiums, given the policy history at the valuation time. The displayed reserve formula expresses this prospective view. Because the enlarged process is Markov, the whole past history can be summarized by the current state and the elapsed duration in that state. Therefore, the reserve decomposes into state-specific and duration-specific reserve functions. This is a major actuarial consequence of the Semi-Markov embedding. In a classical Markov model, the reserve depends on time and state. Here it also depends on elapsed duration. The chapter decomposes the reserve into a premium part and a benefit part. The premium part uses future transition probabilities with terminal duration integrated out. The benefit part combines transition densities, state contingent benefits, transition benefits, and the no transition atom. The chapter also derives a first transition representation, shown as equation 9.4. This representation conditions on the first jump after the valuation time. It is particularly useful for interpreting reserves recursively. The insurer accumulates cash flows while no transition occurs, and after a transition, it pays the transition benefit and establishes the reserve of the destination state. The slide presents the Semi-Markov version of Thiele's equation, corresponding to equation 9.5 in the chapter. The left-hand side is the change in the reserve along a path where both calendar time and elapsed duration increase. This is why the differential operator combines the derivative with respect to time and the derivative with respect to duration. The right-hand side has the same financial interpretation as in the classical Markov model. Interest increases the reserve. Premiums paid in the current state increase it. Annuity benefits paid in the current state reduce it. The final term accounts for possible transitions out of the current state. If a transition occurs, the insurer pays the lump sum benefit attached to that transition and replaces the current reserve by the reserve of the destination state, where the duration is reset to 0. The expression inside this transition term is therefore the capital at risk for the transition. A terminal condition is needed at maturity when a lump sum benefit is payable. The main insight is that Thiele's equation survives in the Semi-Markov setting, but it becomes a partial differential equation in calendar time and elapsed duration. The capital at risk measures the financial jump created by a transition from one state to another. It combines the lump sum benefit paid at the transition, the reserve required in the destination state, and the release of the reserve held in the departure state. Multiplying this capital at risk by the transition intensity gives the corresponding risk premium. This is the expected instantaneous cost of that transition over a short time interval, conditional on the current state and elapsed duration. Summing over all destinations gives the total risk premium associated with exits from the current state. The Semi-Markov Thiele equation can then be rewritten as a decomposition of the net cash flow. Premiums net of benefits are split between a savings component, which finances the change in reserve after interest, and a risk component, which finances the expected cost of insurance transitions. This decomposition is actuarially important because it clarifies the financial role of the premium. It also shows how duration dependence affects both components. When transition rates increase or decrease with elapsed duration, the risk premium changes accordingly, and the reserve dynamics must adapt to that duration profile. The implementation section shows how the Semi-Markov framework can be used with data and simulations. A valuation model is useful only if the transition rates can be estimated and if trajectories can be generated for numerical studies, pricing checks, or risk management applications. The chapter focuses on a practical piecewise constant specification where each transition intensity is constant on rectangles defined by calendar time and elapsed duration. This specification is simple, transparent, and directly linked to observed transition counts and exposure times. Under the piecewise constant specification, the calendar time and duration axes are divided into rectangles. For each transition from an origin state to a destination state, the intensity is assumed constant within each rectangle. The likelihood then has the usual counting process form. Observed transitions contribute a logarithmic intensity term, and exposure time contributes an integrated intensity term. Maximization yields a very intuitive estimator. The estimated rate in each rectangle is the number of observed transitions divided by the corresponding exposure to risk. The chapter also gives the asymptotic variance estimate, based on the observed number of transitions and exposure time. If the raw estimates are too irregular for pricing or reserving, graduation or smoothing can be applied, for example through Poisson regression. Simulation follows directly from the intensity representation. Starting from a state at a transition time, one simulates the next sojourn time from the survival function determined by the integrated exit rate. Once the transition time is obtained, the destination state is selected with probabilities proportional to the destination-specific rates. This provides a complete practical toolkit for estimation, simulation, pricing, reserving, and risk decomposition. The conclusion brings together the probabilistic and actuarial messages of the chapter. Semi-Markov modeling is not merely a technical refinement of Markov modeling. It changes the information set used for valuation by adding elapsed duration as a relevant risk driver. This makes the framework especially well suited to life and health insurance products where persistence in a state affects future transition intensities and future cash flows. The final slide summarizes how this additional variable supports a coherent valuation, reserving, estimation, and simulation methodology. Semi-Markov models provide a natural actuarial framework whenever transition intensities depend on both attained time and elapsed duration in the current state. This dependence is central in many health-related contracts because the probability of recovery, deterioration, or death may change substantially with the length of the current episode. The chapter shows that the technical difficulty can be handled by enlarging the state variable. The process made of the current state and elapsed duration is Markov, and this allows the use of rigorous transition probabilities, reserve functions, and valuation equations. The framework extends the usual actuarial toolkit. Premium calculation remains based on the equivalence principle, but probabilities must account for elapsed duration. Mathematical reserves remain prospective values of future net cash flows, but they become functions of both state and duration. Thiele's equation keeps its financial interpretation while adding a duration derivative. Risk and savings premiums are also naturally generalized through the capital at risk. Finally, the model can be estimated from transition counts and exposures and simulated through sojourn times and destination probabilities. The chapter, therefore, provides a coherent bridge between realistic, duration-dependent insurance dynamics and operational actuarial valuation.